Portfolio Builder members, welcome to our Monday Trade Alert where we trade the SPY ETF. And I'm just bringing up a testimonial from one of our clients from September 5th. He had made a lot of money on the TLT having a downturn, and now we're profiting from it going back up. And so, Kirk, if you're watching this, you better send in that new testimonial. I know we've been piling in some profits on that. So this is what I want to show you guys. When you use the asset allocation that we teach, it makes it very hard to lose money. And although I was expecting the SPY to pop up higher today, it did not yet do that. In fact, we'll look at the news. Still expecting the SPY to break into new highs. But the TLT did its job. And while we lost about $3,000 on the SPY from Friday through today, we made $9,000 on the TLT because we have twice as many shares of the TLT as we have the SPY. And so when you have that overlap in terms of your capital, it makes it very, very hard to have a losing period of time. In fact, we need the stock market and bond market to sell off at the same time to have a very significant drawdown in our portfolio. And at the same note, we always have put options below our assets. So even if that did happen, we'd still be capped off usually around a 1% total loss is the maximum risk we ever have in our portfolio. So other people may sit there just owning these assets, wake up one day and it's down 3 to 5%, and then the next day it's down another 3 to 5%. And such is life in a crisis like we've seen in 2008 and 2000. And in fact, today we will be examining what did the Fed do leading up to the 2008 crisis. When exactly did they start cutting rates, and when did they start printing money? And then what happened to the critical assets that we're trading during that period? Okay, we got our usual crowd on board. Ernest, welcome. Ron, Tom, glad to hear you guys are on our live chat. How's it going this morning for you? Anyone else in there live that wants to say hello, please post in the chat. We do have 10 people watching live right now. And so let's just look at how we got in and out of today's trade versus Friday, what our expectations are, our total strategy, and then we'll jump into the important macro news that is affecting the markets. Okay, so Friday we put on this trade where we sold to let me zoom in on this for you guys. Friday we sold to open the 303 call and bought the 297 put. That means we stop earning profits if the SPY goes above 303. And we stop losing money if the SPY were to go below 297. So once again, we can't lose too much or make too much in any given trading period. And that's because we're trying to safely generate return with extremely low drawdown. So that's how we put on the trade. To get out of the trade today, for those of you who are new to the program, you would buy to close the call and sell to close your put. Now, the new trade alert I will not be revealing in this live stream video because it does go out to the public. You'll need to get that from your email where we control who has access to our current trade alerts. And it's kind of funny. We give away our market predictions in our live stream, and then actually what our clients pay us for are the options trades, which in effect, to a degree, put a drag on our return, but provides a huge amount of safety and protection so that we have extremely low drawdown. So our program's all about safe, consistent returns with absolute safety. Good morning, Ryan. We got Ryan in here. Ryan's the man who makes this all possible. I wake up, get the trade alerts done in the doc, send it to him, and then he gets this broadcasted through the internet via text message, email, and we're also going to add in Telegram. So for those of you who for whatever reason have trouble getting text alerts on your phone because your carrier's blocking text messages, we're going to have a phone app called Telegram you can download as another option, which we'll have out by Friday. Now that will only be for our paid folks, but if anyone is having trouble with text message alerts, please know that that is a definite solution that cannot be blocked. Okay, so that was the way to get out of the trade. If we do zoom in on our total returns, you can see that bond portfolio is just amazing, up 17% this year. We've been long the TLT almost the entire year until it got to an outrageous price where we went bearish on it, collected some good profits. That's what that testimonial from Kirk was all about. And then once we saw the Fed was back, they are going to put in the Powell put. We went back long the TLT, and I'm also long the SPY. So I'm expecting the SPY to break into new highs unless the U.S.-China trade talks break down. Now, there was a fear of this Friday, which I think people are still shaking off, but that has been relieved. We'll look at some news, but China said the U.S. actually asked them not to go view the farms to avoid creating a bunch of drama on the media. And meanwhile, they are buying some soybeans. So things do seem to be progressing in that front. Plus, the U.S. came out with a very strong PMI print. Our housing sector is picking up. Everything in the U.S. is firing at all cylinders. So I'm very bullish in U.S. equities. And I think we're going to see a huge pop in our portfolio one in the upcoming weeks. I know it's been taking a little longer to get that move we've been projecting to occur, but I do think it's coming. So we'll get into that in a moment. Really quickly before we get started with the big news, here's our disclaimer. We have a very high success rate, I would say almost 99%. That's because everyone knows exactly when the trade alerts come out. They know what we're trading and they know how to get in and out of the trades. We're trading the most highly liquid products in the world, so we all get the same fill. It's easy to follow, and one of the few advisories where everyone gets almost the same result. Plus, it's extremely easy on-the-go daily retirement income trade alerts. A lot of our folks travel and place these trades from their phone. Dean says it takes less than 30 seconds a day, but who's counting? My dad says it takes less time to take out the trash. And I ask you, why make investing complex? Don't you have better things to do with your most precious asset, your time? And my promise to you is I will protect your assets and show you how to pick the low-hanging fruit. Our put options hang right below the SPY and TLT ETF make it impossible to lose very much money, period. This is how you can sleep like a baby and simplify your life. Our goal is income and safety, not growth or speculation. The target return on investment is only 1% to 2% a month, and we've only had one losing month of negative 1%. So think back, what's the biggest loss you've had in a month? Is it less than negative 1%? And if you watch this daily YouTube video, you'll know exactly the rhyme and reason of every single trade alert. And I gotta say, it's really nice having my full voice back after 2 weeks of getting over a cold. So hopefully we can get some great content out to you guys this week. I wanted to show you the various ways you can follow the program. There's 3 options we recommend, depending on how often you want to trade and how much risk you want in your portfolio. This is by far the safest setup. You have 100 shares of the SPY, 200 shares of the TLT, and a buy and hold position in GDX. So that would cost $66,000 approximately to build. It gives you a 10% buy and hold portfolio in the gold miner ETF GDX, which we like a lot better than GLD. We were in GLD for quite some time this year. But now I think the central banks will somewhat put a ceiling on the price of gold, and now all the people who mine the gold are going to be the hot commodity to invest in. The SPY and TLT is not a buy and hold. It's something that we have options trading on top of and below at all times to generate income and protect the underlying asset. So we know we're in a gigantic bubble, and at some point it's a big risk that the SPY or TLT could have a serious pullback. And that's why we always want to have that put option down below. It allows us to have much less risk and much less stress in our life that we could wake up one day and suffer a huge loss. Now, if you want an even riskier strategy that takes less time, then you might consider our setup where you just trade the Tuesday and Thursday alert. Now, if you are in our program, I do intend to get out of USO tomorrow and switch over to SLV. If you look at where the funds are massively migrating into this morning, USO is up there. It's in the top 10 of the ETF spectrum. But what's more impressive is that GDX and SLV are having tremendous volume flowing into those assets. And we'll take a look at why I think people are really trying to jump the gun in SLV by looking at what happened in 2009 and 2008 and then comparing it to today. Now, it's not the same, but we'll do a little compare and contrast. This still has your buy and hold. And again, on Tuesday, we're not just buying SLV. We're actually doing the put below, the call option above to turn it into an income machine. We're only buying and holding a much safer asset, GDX, and the market cap of gold is much higher than it is in silver. So I would never tell our folks to buy and hold such a large position in a silver ETF. Now, the best return is to follow the 5 trades we provide each week, and here's how your capital would outlay. Now, do remember we were in USO. We didn't lose any money on that, but it's just not going anywhere, and I'm seeing much more capital flowing into the silver ETF. So we are going to make that switch tomorrow if you want to be prepared for that. Now, if you did not get the trade alert, call Dean at 505-322-7515 so we can get you started. Quick reminder, we have a webinar every Wednesday for our paid members and a free webinar every Thursday for everyone. And if you have not yet, download the YouTube phone app, subscribe to our channel, click the bell, you'll get an automatic notification of this daily live stream so that you can listen to it on the go from your car or wherever you are. All right, guys, so here's the Thursday trade we gave out. Hopefully, most of the people following the program are now following the whole system so that you don't have winning weeks on the SPY and then losing weeks on the SPY while you watch everybody else profit on the TLT or vice versa. And we have had people who are trying to kind of frog hop from one lily pad to the next, which they think is the best, and oftentimes that does not result in the best return. To have a diversified portfolio like we're teaching you here is how we've had such successful results with very little drawdown. And so, unfortunately, we're going to stop making money on the TLT once we get over 143, which is actually, so I've actually understated how much we're up on that particular position, as it was at 143.11 earlier, and now it's pulled back a little bit to 142.46, and I think that's because there's some good information hitting the news wire right now as we're doing this live stream about China-U.S. farming deal coming to some very good progress. And mainly, the U.S. made no concession at all, and China is buying some soybeans. So I guess that's about as good as it gets so far this morning for news, but that has been enough. Okay, so let's look at what we have collected here to look at today. Okay, so Christine Lagarde was on CNBC this morning saying the trade war is weighing like a big dark cloud on the global economy. Of course, she is getting ready to take over the ECB and roll out a bazooka of stimulus is the rumor. Zero Hedge just with a comical tweet. Great time to not only cut rates but also launch QE as a surprise index is hitting all-time highs. Our PMIs are at 51. Retail consumers strong. Let's see what else has been. Housing pickups jumped considerably. Everything's looking very good in America, besides perhaps the growing deficit and level of debt. But relative to everyone else, we're still doing great in terms of that. The dollar index is incredibly important to follow right now. This continues to show the trend that the rest of the world is collapsing, their currencies are losing value, and everything is just flowing to the United States as the safe place to invest. Now, in 2008, we had a clear catalyst. We had banks collapsing, and we had a lot of people not able to pay their mortgage payments. And so that turned into the financial crisis of '08, and that's what created this panic. So now we got to ask ourselves, what is going to be the next financial crisis, and what will be the cause of that panic? And so I think this time it's either going to be China's crash or perhaps Germany's crash with Deutsche Bank, who's dramatically tied really to the hips of China. I'm pretty sure it'll be either one of those will be the catalyst that creates the big financial panic. And most likely what I really think is going to happen is China is going to create a financial crisis by devaluing their currency when we figure out that the U.S. and China are not going to make a significant trade deal. Now, I'm not expecting this crisis to happen right now. We have the 70th year anniversary of China, when I believe it's when their Mao came into power. And so I think they want a period of peace going into October. So we'll see how that all plays out. But I do want to note, here's the federal fund rate. And you can see that as much slack as much hate as the Fed gets, they actually have been pretty accurate at predicting problems before it happened. You can see they're aggressively dropping rates into recessions before the recession hit and before these crashes hit. And so we can see in 2000 they predicted it, started dropping the rates. And then also in 2007 they started dropping the rates before the crash. And so now you can see this exact same setup. And you got to ask yourself, do we have a recession in the books? Is there a stock market crash ahead? Because they're doing the same thing. They try to pick up those rates, and then once they did, markets started to tumble, and now they're back to lowering rates. Now, this time, they seem to be willing to actually try to prevent the crash more aggressively than they were in 2008. And so what I want to point out here is, let's look at this chart. So it was in November and December of 2008 where their balance sheet jumped $1 trillion, okay? So it went from a $1 trillion balance sheet up to $2 trillion in a single month. And that's when the whole stock crash completely ended. And we had a massive rally, and they continued to print money all the way up until mid of about 2015. So the question is, will they aggressively increase their balance sheet before a stock crash, like it seems like they are? And in fact, I do want to point this out. Let's zoom in here. What you can see, if we do zoom in, is they have started to add to the balance sheet. So they've not announced official QE, but they have been coming in there and helping support the Treasury market already. So let's look at this picture of silver. And silver picked up this trend about a month before they actually injected all the money, and had a run from $10 up to $47.50 for about 3 years. Now you can see the balance sheet runoff didn't end until 2000, or rather, balance sheet run up didn't stop till 2014. But we got this about two and a half year bull market in silver during this period where they aggressively added to their balance sheet. But now we're looking at a stock market that's all-time highs, They're already starting to lower the rates. They're increasing the balance sheet. Will they do this aggressively? And that's what we're really watching for right now. And why I think you're seeing more money pour into GDX and SLV than most other ETFs this morning. Now, looking at the important tickers, here's a little snapshot overview. I'm looking at emerging markets. This was actually one of the highest traded ETFs today, and actually most of this year. Money continues to flow into that. It's interesting that Germany has entered a recession. Their PMI has dropped negative. Their rates are negative. But yet their stock market is looking somewhat healthy, which is interesting because if we are predicting a crash in China, which I do think is in the books and almost guaranteed to happen, we got to ask ourselves, how can we profit from that? And I've become less certain that it can be achieved by shorting their stock market. And I believe the real opportunity will be shorting their currency. I think they will be ready to devalue their currency to support their economy and try to fight the tariffs. And so we'll talk about that in a little bit. Some serious weakness in the Chinese stocks, but these were near highs as well, or at least recent highs. Here's that SPY sell-off. I think that this is about ready to pop significantly higher as we now have the POW put back in place and everything in America is running at full capacity. There's a SPY 10-year chart. And for me, what's really important is to ask yourselves, what's the main buyer of the SPY? It's corporate buybacks. Okay, now how are they getting the capital to do that? From the corporate credit market. So if that corporate credit market's still intact, it's going to take a major scare to actually create a significant sell-off in stocks. So here's the TLT over the last week. You can see we went long the TLT several weeks ago, and it's been printing us very handsome payoffs as we wait for the SPY to finally get past this 300 level. And we did manage to short the TLT over this period. So whether you want to call that luck or whatever, for the 3 weeks we went short the TLT, we really did well on that. And then we went right back long the second we saw the Fed come out with these repo rates. GDX getting a huge bid. Look at the little bars down here. Tons of volume coming in. The paint is on the wall. Looks like QE will begin in November. Here's LQD, the investment grade bond ETF, looking strong. This is a 3-month chart. If this does not crash, I don't see how we're going to stop this cycle of corporate buybacks. They're essentially buying themselves out and getting rid of all the real investors out there. High yield junk bond debt still at an all-time high, even stronger than the investment grade. IWM, the Russell 2000, looking very strong. If this can break out of this level, we may have a very significant bull market ahead in equities. Here's a look at Germany's ETF. Not at all-time highs, but it's not in some sort of serious crash like you might expect with all the bad data coming out of it. South Korea's exports were another month of terrible exports and a decline. It does look the weakest of all these, down about $20 a share. Emerging markets continues to get bid, hoping that there's a U.S.-China trade deal. So we'll see. Maybe we get some sort of action because of this holiday they have coming up. But I'm becoming more and more skeptical that it will really occur, because it would mean that China would have to give up its competitive edge in the world. So it's not clear if they will really be willing to do that. We have been trading USO for 1 week, and I think it still has some good opportunity. If we get a good U.S.-China trade deal, part of the package they just said last week would probably be buying up massive amounts of oil and gas. So if we get a trade deal, I might be tempted to get out of silver and jump back into USO. But right now, it has everything in the world going for it. It's not moving. We didn't lose money on this USO, but we didn't make anything. So I'm going to go ahead and switch us out tomorrow from USO to SLV. Now, again, this is with puts below, call options above. We're not just winging it on very risky assets like that. You can see that huge jump in silver, 3.5% this morning. Crude had a headline coming out saying that Aramco is going to take several months to get production back up. But meanwhile, they came back out this morning and said, no, we'll have it back up by the end of next week. So I'm still watching that one carefully. But I think perhaps we need to wait for an official trade deal to give us a catalyst for high demand for oil and rising oil prices. And that may be in the books. We just got to watch this farm deal very carefully. Because of last Friday, we got a scare that it was breaking down, which would be very bearish for oil, obviously. This is the way I think you can profit from shorting China. And it's not going to be their stock market. It's going to be their currency. And I believe they will let this run up significantly higher if they have more and more problems. And sure enough, they are having problems in every way possible right now. They took on too much debt, and now America's putting pressure on them. And that's just the recipe to create a crash in China. So I believe this could go significantly higher. Now, this is not something you can short in the stock market in any shape. The only way to get good exposure to this is either with a futures contract or a futures options contract. And every penny this moves is either a 10% gain or loss in your favor. So you got to be very careful with the timing. This is something we're going to only alert in our boot camp program. So we do have several people who've already signed up for that boot camp. If you're not in it and you want to be able to have the trade for this, we're going to be trading it with the futures market, most likely with the futures options market. We're going to have to pay a nice premium, but then we don't have to worry about 10 cent move against us creating a 100% loss on our position. So it's just too risky to probably use the futures market directly. So we'll most likely be using the futures options market. This allows us to have the option to execute that futures contract in the future if we're right. And the timing on this is going to be important too. I don't want to pull the trigger until we get the official Trump tweet saying he's raising tariffs. And we've seen the reaction of the Chinese several times now. Every time the Trump comes out and says they're going to raise tariffs, they just devalue their currency to offset the effects. So based on how high he does raise the tariffs, we can, to a degree, predict just how high they're going to devalue their currency or push this exchange rate up. And again, every penny that we can predict is a 10% gain. So just to get to the most recent high would be 7.2. But I think if we get more aggressive with the tariffs, they may push this exchange rate from somewhere to 7.4 to 8. And if you look, just back in 2018, the conversion rate was below 6.5. So people who've been playing this are already up 800% in the last 2 years from playing that trade. So again, if you want to join our boot camp and be able to play this, we'll probably be using around 1% to 2% of our total portfolio at the right time to buy a futures option contract that will be designed around where the tariffs hit. So if we know the tariffs can hit December 15th, they're going to devalue their currency before that event happens. Now, my fear is that we do get some sort of trade deal that delays the December tariff. So I'm not ready to put that trade on yet. But if we're right, we're looking at a potential 400 to 1,000% gain on a small position. Again, I'm not going to put more than 1% to 2% into this trade by predicting that they will continue this trend of devaluing their currency to offset the tariffs and also to pump money into their perhaps broken business model where they just go build ridiculous amounts of construction everywhere that's now collapsing. Also, we're seeing China starting to pull out from their Belt and Road Initiative as they are clearly running out of money. As far as predicting the bond market, we like to follow Germans. They are the best way to judge the health of China. Can't trust anything out of China, but we can trust what the Germans are doing. Their biggest trading partner is China. Germany's having a terrible time right now in a recession. Bond yields are going into negative on the 30-year. So it really couldn't get any worse. And perhaps Deutsche Bank could be the real snap in the market. If Deutsche Bank were... Now, they have been aggressively deleveraging that bank, getting rid of assets, firing people. So maybe it won't be the Lehman moment of maybe 2020, 2021. But it's certainly going to be a good canary in the coal mine for us. UK is not doing any better. And so you can see the strong correlation. I'm a little surprised crypto's not bidding a little higher today with gold and silver, but you can see it's not selling off either. And so for those of you who do like to trade crypto, if you didn't want to have a 10% position in GDX, take off 2%. Put 1% in Bitcoin, 1% in Ethereum. That's what we're really recommending and doing in our actual portfolio. And when the time comes, we're probably going to pull off about 2.5% of that GDX and put it into the futures options contract. But that trade alert will be exclusive for our bootcamp members because we're going to have to especially support people who have never traded futures before. Most folks in our program are pretty good with stocks and options. And so that's why we've separated those two. It's a totally different animal. Now, it will be a very quick trade. You're not going to do a lot, but we got to get you approved for futures options to be able to play that trade. There's your South Korean exports collapsing again. Another canary in the coal mine. Here's your German PMI, almost at 40. That is really bad. Hard to say what exactly is going on over at Aramco. They say they'll have everything up and running by the end of the week. Wall Street Journal came out saying it's going to be months. And so I'm keeping a close eye on that relative to our USO, but I'm just not seeing it. It all makes sense, but we're not seeing the action. We are seeing the action in silver. So again, Tuesday we will switch over if you want to prepare for that. Here's a look at the central bank balance sheet and the projected increase. So they're projecting $2 trillion in the next 2 years being added to the balance sheet. We'll see exactly what happens, but that's why we're seeing this big front run into gold and silver right now before it's officially been announced. And again, they did the same thing in 2008, 1 month before all these announcements hit. Those were starting to get a bid. Factory activity, this is from Bloomberg, plunging to 41. We just saw that chart, weakest level in 6 years. So there's going to be some massive money printing to try to prevent this in the globe. So that dollar is going to continue to be strong. Going to continue to see that play. This is the option contract that I'm looking at in the futures market. Not necessarily the date strike, but just to give you a feel for what we will be doing in our boot camp. And again, this little trade, which will probably represent 1 to 2.5% of our portfolio, depending on how high the exchange rate gets, every penny that we can predict is approximately a 10% gain in the futures market. So most likely we'll look at the tariffs that come out. We'll be able to calculate what sort of devaluation the Chinese need to do to compensate for that, and then look at when the tariffs are going to hit. And that's pretty much your formula for predicting when the Chinese will devalue their currency and to what level. So we'll be able to use the futures options market. So if we're wrong, we don't get annihilated. But if we're right, we have that option to take advantage of that futures contract. So it's a lot like the call options in the stock market, and the put options allows you to speculate without having to actually own the underlying asset. So the premium we put up will be the amount of money we risk, and if we're correct, the reward can be very, very handsome. This also lets us get more future contracts by using the option than we would normally. So if we were just going to use the futures market, it would be a tiny position because we know it could swing against us. Now, if we use the options market, we could pay that premium and get many more futures contracts in our portfolio with a lot less risk. Now, again, options markets are typically priced for the buyer to lose money. So we will wait until Trump officially raises the tariffs and then be able to calculate the date and the strike based on exactly how high he's going to push those tariffs. And they've been talking about 50 to 100% tariff rates, which would mean they'd have to go way above 8. So we'll see if they would really get that aggressive with the tariffs. But that is probably the most obvious, huge returning trade I see right now. If we can project that the U.S.-China trade war is not going to get a serious deal because it would mean China would have to give up their competitive advantage in the world. All right, guys. Well, that is a wrap on our trade alert today. Let's see if we have any questions out there. And again, if you do want to make sure you don't miss out on trade alerts, or you want to join the boot camp, call Dean 505-322-7515. It's going to start in November, but because we already have members who've joined, I am prepping them for that futures trade that is going to be issued after we get rising tariffs from Trump. So it's really that simple. Got to wait for the catalyst to officially hit before we buy that premium and buy that call option. Any questions out there, guys? Alrighty, well, another great live stream. Thank you everybody who joined us live. Ron, Ernest, Tom. We got our webinar coming up Wednesday, Tuesday. You guys already saw the plan. We're going to switch over to SLV. Still looking like we will have a good run on the SPY to new highs, which I'm excited to finally see pay off. And then meanwhile, that TLT continues to surprise us to the upside. Hard to believe we have a 17% return on the TLT this year, but that's what we got. So, okay, thank you so much, guys, and I look forward to a new trade for you tomorrow.